Hello value investors, thank you for joining me. Today I want to talk about Datadog. My name is Michael from Deep Value Returns on Seeking Alpha. So we're going to talk about Datadog and what's compelling about this SaaS business. We're going to talk about its growth rates and then we're going to talk about its valuation. So let's just jump right in. So you can see here that Datadog's ability to give investors what they really want, which is that strong growth rates and that visibility, is demonstrated here in the graph. So if you remember, if you look back to Q1 of this year, Datadog was growing at approximately 51%, and investors were like, okay, this company came out, did the IPO, and then 2020 was very strong, and many investors were saying, okay, all these SaaS stocks did really, really well, and in 2021 they're not going to be doing as well. And what actually happened is that it's accelerated coming into Q2, and it put out this very strong guidance for the rest of the year. What's more, they're talking about billings being up 69% year over year. So as you know, billings is a leading indicator that investors look for, because billings show how much of the pipeline is still booked up but hasn't been recognized as revenue. So that means that it has a very long runway ahead of strong growth, because 69% in billings is significantly higher than you can see the next several quarters of revenue growth rate that they've guided for. So there's still a lot as we go into 2022, there's still a lot of runway here in this stock. So this is quite compelling, right? Another thing that I always look toward is the company's ability to onboard customers. So the number of customers that they have an ARR, annual recurring revenue, of more than 100K was up 59% year over year to 1,600. This is not their total number of customers. They have more than 12,000 customers, but these customers that spend more than 100K per year account for about 80% of their total ARR. So, this is a very strong indication that the company is getting customers on board. Also, the dollar-based net retention is above 130%. So that means customers come on this year, next year they'll be able to cross-sell them more than 30% more revenue. So that's what you really want in a business. You want more customers coming in and you want pricing power. And this is a very strong indication here the business has what it takes to continue plowing ahead. Another thing that I want to talk about is that there's this whole tailwind right now that as companies migrate to the cloud, the need for observability and security, just going for one-stop shop that provides everything for the company is providing a very strong tailwind here to Datadog. And Datadog is clearly taking market share away from, let's say, Dynatrace or Splunk, and it's just unquestionable. Even as the other companies are some of them have done reasonably okay, and some of them have fallen behind, Datadog has just plowed forward. This is this is the best metric that you can really look for, is the ability of a company to get customers on board and being able to grow its revenues, for a long period of time at a high rate. Now, here's one problem. The company is priced at approximately 32 times next year's sales. The way I figure this out is that if we say that this year they've guided obviously to grow at 56% year over year, and it's a SaaS business, so there's a lot of recurring revenue. So they have a very strong ability to kind of have these multi-year contracts. So if we say that this year they grew 56% and next year it decelerates and it grows at 40%, which is a 13% deceleration rate, I think that's reasonable and that's conservative, and that implies that next year they have 1.3 billion in revenues. That's already, obviously it's an important metric, because it's showing that the company can grow at scale at more than $1 billion in revenue. So it gives investors some kind of confidence in its ability to stay here for the next decade ahead. So with all that in mind, that would imply that, given that Datadog is priced at 42 billion right now, that puts the stock next year at 32 times next year's sales. Now, we're in August right now, so for many investors, they're already trying to think about how 2022 is going to look. This is at the high end of the SaaS world, so I picked out a few names here. So you got Zscaler, you got Cloudflare, you got Snowflake that are priced at above 30 times. You also got Asana that's priced above 30 times next year's sales. But last year's favorite, which was CrowdStrike, is no longer priced at above 30 times next year's sales, now priced at 28. So you can see that the market is kind of starting to be a bit more discerning where they really want to be paying a large multiple for. So there's a lot here to really be attracted to, but what puts me off here is that the valuation is punchy. And what I say to investors, okay, you have to bear in mind that there's a lot of competition out there, and you got the likes of Splunk and Dynatrace that I already mentioned, that they also offer competing products. So these companies are going to try and eat away at Datadog's smaller competitors. I don't think they'll manage to take away market share from Datadog's on the larger competitor side, but on the small competitor side, I think they will eat away, at least as they compete on price. So as Datadog starts to saturate a large number of enterprises, it's going to have some difficulty going into smaller enterprises. So this is something to bear in mind. Now, what I say to investors is, if you're really determined to be a shareholder here, adopt a buy and hold strategy. This doesn't mean you buy when the share price is going up and then you panic and sell when things turn sour. Is you dollar cost average over time. So let's say every 60 days or something like that, you add a little bit more of your portfolio to here, and you say to yourself, from the moment you want to be a shareholder, you take a really long-term view of the company, and you say, okay, I believe that this company is going to do quite reasonably well over the next, let's say, 2 or 3 years, and I'm going to take my time buying into the company. It doesn't mean you kind of go crazy and imprudent right now and you buy loads and then you kind of become overwhelmed. You try and be reasonable, mature and professional about this, with this type of view in mind. So as I said, this is not a company that I'm going to be investing, because it's a bit punchy for me. But if you want to know what kind of stocks I'm really excited about, I normally go for stocks that are, the outlook is not as rosy, and there's a few hairs on the company, but I feel that the valuation more than adjusts for that, because you kind of get a cheap valuation, and when things work out, things, it can be a nice return on investment. So if you want to find out some of these names, don't forget to check out my marketplace. It's called Deep Value Returns. I'll tell you the names of the stocks I own. You're welcome to do a totally free trial to see if it suits you. There is absolutely no reason for you not to give it a shot, and we've got a growing investment community, and if you like it, you stick around after the trial, and if you don't, you unsubscribe anytime before 14 days, and you're not going to get charged anything at all. So anyway,